Now, we all know that the cost of buying a used or new car has absolutely skyrocketed in recent years. And while on my channel we talked a lot about how car prices have increased to unattainable levels, and thus car owners and car buyers are falling behind and going delinquent on their loans and getting their cars repossessed at a growing rate due to astronomical costs. And while this is absolutely true, one factor at play when it comes to rising car costs and delinquent auto loans is just the increased cost of ownership for a car. Not just in regards of car payment, but also in regards to things like maintenance and repairs, parking and fees, and of course, insurance. These are all costs that post-pandemic have been increasing at a rapid pace, and in some cases have no signs of even slowing down. And this is crushing car buyers and car owners. And this is especially painful given the fact that in the United States, because of how unwalkable most of the country is, most Americans are forced to buy and own a car, even if Americans don't really want to own a vehicle. And as different aspects of owning a car have become more and more expensive, car owners throughout America are essentially forced to pay them. According to the Wall Street Journal, parking and fees associated with owning a car rose by 3.8% year over year. Maintenance and repair costs have increased by 6.5% year over year, but insurance is where our pockets really begin to hurt. Because according to the same report, auto insurance has increased by 20% year over year, with some reports showing an increase of 22%. And according to the Bureau of Labor Statistics, this is the fastest increase in insurance rates that we've seen since the 1970s. In fact, according to the Federal Reserve, high insurance costs is one of a few reasons why inflation hasn't cooled down further. Now, as to why insurance costs have gone up so much in recent years, well, it's complicated. When you Google something online like why are insurance costs so expensive, a very common reason that pops up online are things like people going out of lockdown and thus more and more people are on the road, vehicle parts have increased in price and thus the repair for cars have also increased in cost, or more frequent and severe accidents. And while this was all true circa 2021, it's not exactly true today. And there are a few additional reasons as to why insurance costs have gone up so substantially in recent years. One relatively unknown reason as to why insurance costs have risen is because of interest rates. In 2021, insurers were holding loads of assets that would lose value if short-term interest rates rose. And so when interest rates did rise, insurance company balance sheets and books took a turn for the worse. And while it certainly isn't our fault that interest rates went up, ultimately this caused insurance companies to lose money, and we are now eating the cost of that. Now, in addition to interest rates, which absolutely plays a role here, if you know anything about insurance, you know that as accidents and claims increase with insurance companies, the amount of money that insurance companies charge for that insurance also goes up. This is to offset the amount of money that insurance companies are bringing in with the premium versus the amount of money that they're paying out when people file claims. And so surely, if insurance costs went up in 2023 and are projected to increase in 2024, that must mean that claim rates also went up in 2022 and in 2023. Well, not exactly, at least not in most recent years. According to Geico's 2023 data, which is our last full year data we have, premiums written reached $39.8 billion, an increase of $730 million compared to 2022. Geico's loss ratio was 81 in 2023, a decrease of 12.1% compared to 2022, and underwriting expenses declined by $752 million, which was a decrease of 16.5%. So Geico's cost to insure you, us actually, in 2023 went down, and yet the insurance that we pay went up 20%. Progressive reported 2023 earnings back in February, and their combined ratio decreased as well. Now, combined ratio in the context of insurance is a quick and simple way to measure the profitability and financial health of an insurance company. The combined ratio measures whether the insurance company is earning more revenue from its collected premiums relative to the claims it pays out. A combined ratio of over 100 means that an insurance company is losing money on their claims, while a combined ratio of under 100 means that the company is making money, and that the amount of claims that they pay out is less than the premiums that they brought in. The lower the combined ratio, the better. And between 2022 and 2023, Progressive's combined ratio fell from 93.9 to 88.7. They also reported a net income increase of 141% and a 22% in premiums earned. This is another example of an insurance company that's charging more, that's making more, but is ultimately paying out less to their customers. Farmers saw an improvement of their combined ratio as well from 106% 106.2 to 103.3. But in the fourth quarter, they saw a combined ratio of 89.9, which was far better than expected. Allstate decreased their combined ratio, and across virtually all major insurance companies, we're seeing the exact same thing. There are pretty much blanket improvements year over year with the amount of claims that insurance companies are paying out and how much these claims are costing them. As the year has progressed, claim rates have gotten even better and better for these insurance companies. For example, claim rates in December of 2022 were worse than claim rates in December of 2023. Better ratios mean less claim payouts for the insurance company, which means that they're making more money. Which means that in theory, drivers should be less risk because these insurance companies are paying less in claims. And as a result of this, premiums should be going down, but they're not. And while insurance companies are reporting record profits and are seeing their stock prices climb truly on the backs of drivers that not only in many cases need a car to function in many parts of the United States, but are also required by law to buy insurance, it really is an unfortunate and extremely frustrating situation that leaves consumers with little to no options. And so, why is all of this the case? Why have insurance premiums gone up so much despite the fact that loss rates have actually gone down? And while there are a few reasons as to why this is the case, one of them is regulation, or I guess inefficient regulation. Insurance companies are regulated by the states, not by the federal government, but for the most part, these states all have similar rules, and that is that insurance companies actually can't raise prices anytime they want to any amount at their discretion, even if that does feel like that's exactly what they're doing as we speak. Insurance companies have to ask state regulators permission to raise prices, and with that request, they have to provide data on loss rates, premium payouts, and why in this instance a price increase is justified. If the government feels as though this request is legitimate, then the price increase request will be approved, and then those cost increases will be passed down to us, the customer. But if an insurance company reports too much profit, and thus the price increase was in fact not to cover losses, but instead to line the pockets of the insurance company, then the insurance company actually has to return some of that money. In fact, in 2020, during the pandemic, when people stopped driving due to the lockdown, as you may expect, insurance claims declined. And as a result of this, insurance companies made too much money and had to pay $13 billion back to their customers. But because of the pandemic, there was pretty much a hold of insurance rate increases between 2020 and 2021. This means that we as consumers didn't see price increases with our insurance during this period of time. But it also meant that once insurance companies did submit their price increase request, it created a massive backlog because all of these companies did it around the exact same time, which was mid-year of 2021. Not only that, but by the time we reached the end of 2020 and into 2021, vehicle accident claims actually increased. And so whenever insurance companies submitted their request to increase premiums, they did this using data from 2021 that showed an increase in car accidents and vehicle incidents. This, paired with the backlog with insurance regulators, has led to many insurance companies leaving certain states and leaving consumers with less options, and the options that they do have available to them are more expensive. Now, I'm going to be honest, whenever I was looking up insurance data for the sake of doing research for this video, a lot of the data is really conflicting, and you can actually spin the data depending on what side of the argument you're wanting to support. For example, cars becoming more expensive and more technologically advanced is often cited as a reason as to why insurance premiums have increased as well. Cars are more expensive, they're more advanced, they cost more to fix, and thus premiums are more expensive as well. But according to reports, the average estimate for a front-end claim is $3,706, which granted is up more than 15% year over year. But on the flip side, vehicles that are 7 years old or older are actually about $1,000 less to repair. So rather than costing about $3,700, they cost about $2,700. Now, you could theoretically use this argument as a way to justify an increase in premium costs. But whenever we look at the average age of vehicles on the road today, that same argument doesn't really stand up. Because according to Automotive News, the average age of a vehicle today in 2024 is 12 and a half years old. So the cost to repair the average front-end collision isn't actually $3,700, it's closer to $2,700. Because the average car on the road today isn't a new car, it's a 12 and a half year old car. Another example is pedestrian death. Pedestrian death skyrocketed during the pandemic due to distracted driving, but in 2023, this actually went down by 4%. And while many 2024 articles about insurance rate hikes quote reports from early to mid-2023 stating that insurance claims were more severe and more costly for insurance companies in 2022, These same articles fail to mention that in 2023, overall fatal car accidents declined. In fact, according to the NHTSA, fatal car accidents decreased by an estimated 3.6% in 2023 compared to 2022. Though in 2021, they did increase by 10.5%, which was the highest level we've seen since 2005. Still, insurance premiums went up by 20% in 2023, while vehicular deaths and pedestrian deaths both declined. Now, if there is one thing that I've learned over the years, and it's really solidified this as I've done research for this video, it's that insurance is an incredibly complex issue. And whether we love it or hate it, in 2021 and in 2022, insurance companies no doubt had a justification to raise prices. Between record high fatal car accidents, record high pedestrian deaths, and an increase in overall car accidents, mixed with more expensive vehicles, parts delays, etc., there was no doubt justification to increase premium prices. But like many industries and companies since the pandemic, the dial has just simply swung too far. And like we've seen with food and groceries, vehicles, clothes, nearly everything we purchase today, companies are using circumstances, whether that is inflation, higher cost of goods, or in the case of insurance, riskier drivers, as a way to justify a larger price increase than is necessary. And the reason why we know that this is true is because if it wasn't, insurance companies wouldn't be reporting record profits and declining loss rate. Now, I wish I had a call to action for this video. Something like, wait to switch insurance companies until the end of the year because prices will go down then. But unfortunately, that doesn't look as though it's going to be the case because it is predicted that insurance premiums will actually go up this year by 7% as well. And as a result, the cost of car ownership will continue to go up before it goes down. The truth is, we are all in a bit of a waiting game, waiting for premiums to go down, waiting for insurance regulation to return to normal, and hopefully once this happens, many of us can get a check back from insurance companies just like we did in 2020. But until that happens, insurance costs are going to continue to go up short term. Remember that my course, the Car Sharing Masterclass, is on sale until May 27th. You can use the code Memorial Day 150 to get $150 off that purchase. And like always, you guys, I hope that you enjoyed this video. If you have any questions, comments, if you have anything to add, I would love to hear it. So make sure to leave a comment down below. And while you guys are at it, make sure to hit the like button, hit the subscribe button, and hit the notification bell. And I will see you guys in the next video.